Hi everyone, good afternoon. I hope everyone can hear me. My name is Anu and I'm a part of the customer success team at Snap. I'm here along with Lee Martinson, who's our very own customer success manager. Welcome to our product walkthrough and Q&A session today. The main agenda of our session is to offer our clients an opportunity to ask us any questions, get a refresher on some of Snap's functionalities. So today, our goal is to create a new plan for the clients, Barbara and Jay Steele, and answer the most pressing retirement-related questions for them. We already have a filled out questionnaire from Jay and Barbara, and we have already shared that in our handouts, which you can find. And in case you would like to follow this questionnaire along, or maybe even use it later for your practice. So I'll quickly point out on how you can ask us questions during the webinar. You'll notice a questions box, and if you don't, please click onto the orange arrow to open up the control panel. Again, thank you so much for joining us. Now, let's jump into the Snap website and look at how to start creating a plan for our clients. So before we begin, let's look at our help center, or where you will find an exhaustive knowledge base of anything that you want to find in Snap or any functions that you're not sure about. So when you have logged in into Snap, on the top right-hand side, you'll find this help button. If you click on it, we can go into help center. And here you have the knowledge base, a little search bar where you can type in anything that you aren't sure about. If I, let's say, type in RSPs, you get everything related to RSPs right here, or you can use some of these styles that have the information related to the topics that we are looking at. So assets and debts or any other place. One place that you can go anytime if you're unsure about or you see any recent things in Snap. You can click on the what's new and click on our what's new article to find in the recent updates, like our recent release notes from August 22nd, 2023. Okay, now if we go back to Snap, and then let's get started with our client's information. And Lee will be helping me out with the client data from the questionnaire and also answering the questions along the way. So I'm going to click on new client to input the information for our clients. Awesome. So we can put in their information now.
Okay, thanks, Anu. So it's Jay Steele, and his birth date is 1960 05 01,
Perfect.
and he's in Ontario.
Awesome. Thanks for that. And are we adding a spouse here?
So Barbara Steele is his spouse, 1962, and June 1st, so 0601.
Great. Awesome. So now when we input a client and spouse information, you will notice that on the top left-hand side, we get to see the two tabs for our clients. We have Jay and Barbara right here. I have the option to toggle between Jay and Barbara to input any of their information individually. Either we can go from start to finish for Jay and then jump under Barbara's tab, or like I said, we can toggle. So I guess that's what I'm going to do here. I'm going to hit next and input more information for them. So now for Jay, he wants to retire at age 65, and correspondingly, Barbara will be retiring at 63. The projection we are running for them is until age 100. That ends Barbara's plan at 98. So the same year Jay turns 100. So we're going to run through the plans until that year. Just a quick tip here is that you could hover over any of these gray question marks and it will give the information of what Snap is expecting you to input in that section. Sometimes if it's not clear, then these are super helpful where you can get more details. Maybe you aren't clear on any of these things, then you will get the further details when we hover over these question marks. So onto the general page, we are inputting the retirement age, when the projection ends. We're looking at some general inflation rates, which by default, as per FP Canada guidelines, is 2.1%. So we'll run with these. But when it comes to the rate of returns, we might want to lower the rate of return slightly to include, or actually to not include any management fee here. So we'll update it to reduce it by the management fee. Lee, can you give me the percentage that we want to input for them?
Sure. So we're going to use 2% for cash and
Right.
2.5% for fixed income. And we'll just say 5.7%, 5.87, sure,
Okay.
for equity. And if you'd like to save those for your default rates of return going forward, you can use that defaults button at the bottom and select save for new scenarios.
Awesome. So I'm going to click on Save Current Page Settings for new scenarios. So anytime we open up a new plan, we're going to see these rates of returns each time. Thanks for that, Lee. Okay, so we're going to move next and look at the expenses page, which is our brand new section. And here we get the option to input a base expense for Jay and Barbara when they hit retirement, which is going to be 65 for Jay and 63 for Barbara. So do we know that value? Let's
Yeah, so we're going to use $108,000. That's what they let us know on their questionnaire. And yeah, like you said, it's going to start at retirement, and it's the after-tax annual amount that they're wanting to spend on their lifestyle expenses.
awesome. We also have the section for additional expenses here, which really means we can input any non-occasional expenses for our clients. And if I hit add expense, I get to input some of the information. So we're going to do that for them as well, for Jay and
Yeah,
Barbara.
let's put in a vacation that's going to happen. Okay, so the amount will be $10,000 and it will be
Okay,
joint.
awesome. So I can say yes to joint here.
Joint will just mean that they'll each be responsible for half of that amount. It will increase with inflation.
Okay, so now for inflation, I have the option to input any amount, or if I simply hit backspace onto the inflation section, it will stick to the general inflation, which in our case on the general page is 2.1%.
Okay, so it's going to start from the first year, so you can leave that blank to start in the first year,
Okay,
but it is going to end before the end of the projection, so it's going to end at age 80 for
okay.
Jay, and it's going to happen every 3 years.
All right, so for my two age, so I'm going to leave the from age blank. As Lee mentioned, the two age is going to be 80. I can click on this gear icon to be more specific with when we want to start or end the expenses. But in this case, we're just going to stick with 80, which is going to mean the last day our client turns age 80. Frequency every 3 years. And also we have this option to highlight this expense, which really means on our charts, if you want to specifically focus on these individual expenses to see how they are going to be coming out from the client's cash inflow. Now, in this case, we just have one expense, so we can either say yes and no. Maybe let's do a yes to show them in the charts as vacation expense. Awesome. So thanks for that. Let's move on to the next part. And we're looking at incomes, and it says J here. So we want to be very careful of where we are entering any of the client's information. I'm inputting the employment income for J.
So it's $90,000, and
Okay.
we can index that.
Awesome. So because it says 0%, I'm just going to hit backspace, and that's going to give me the general inflation. The type is employment. There are some other options to choose for. In this case, it's just employment. It's taxable, RSP eligible. The from age, again, if it's blank, it means from now, the year of 2023. And to age is 864 because our client hits retirement at the start of the year where they turn 65, and here the employment ends at 64. And if I click on this gear icon, it's the last date of the year they are turning 64. And again, we can change these to be any different date, and that will prorate the last year's employment income. Awesome.
Yes,
So
there is a pension, so
okay.
defined benefit pension, which is for Jay, and it starts at 65.
All right, so then I start at age 65. Now, we can use the before age 65. That will include any bridge benefits if there are. I can use the question mark as my little tip there to look at the details. But in this case, because it's age 65, sorry, so I'm going to input the amount.
Sure, it's $55,000 with 80% survivor benefit and 2% indexing.
Awesome. All right, so when I click away, after inputting any information, it's going to autofill anything that's either missing, or it will give us a little red error to let us know that there's some information that we need to either fix. So in this case, it all looks good. And Let's jump under Barbara's tab to input Barbara's employment income here.
Okay, so her employment income is $110,000, also indexed. We'll do index with inflation.
All right, so my backspace works there. And her employment also ends at 864 for her, and that will be the year of 2026.
I think, what did we say for her retirement? It was going to be
Yeah,
63,
let's go
didn't we?
back and fix it. So it says 63 here. So I guess I'm going to go on to Barbara's employment income and change it to 62 so that when Jay retires, correspondingly, Barbara is also retiring. So that fixes it. Okay. Yeah. A few things that you want to look out for. Okay.
Mm-hmm.
So let's go on to the next part, which is the assets information for, again, we're looking at Barbara first. So let's try and input her information. Now you're going to notice this default non-registered account created, and this is just a starting point for us to input any information for them. But or if we don't know any information and we just want to run through a plan. In case of our clients, they filled in and gave us all the information in detail. So I'm going to delete this one and start with a fresh capital asset account right here.
Okay, so let's add an RSP that's $375,000. And
So the type is RSP/ref. I'm going to put that there. We
and
can,
then, yeah,
yeah.
0% cash and let's see, 30% fixed income and 70% equity.
All right, well, that's great. Thanks for that, Lee. So now this gives us the asset mix. We want to make sure that it's 100% between cash, fixed income, and equity. Now the rate of returns that we see here, if you notice, these are the same that we input under our general page. And the total rate of return gives us the weighted average of the asset mix to the rate of return. Now let's add another capital asset for Barbara.
Okay, so she also has a TFSA that has $85,000 and the same asset allocation.
So I'm going to say TFSA right here, the same asset allocation. So we can do 30 and 70. I'm going to click away for all the other information to get filled in, which gives us the total rate of return. All right.
Okay, then they have an open account, just a non-registered joint account that has $20,000.
20,000 in value. It's a non-registered account. Now, when I hit non-registered, it gives the option if it's joint, yes or no. I'm going to say yes. So we're going to see this capital asset automatically show up under J's assets. Do they have like the same asset
We'll
mix
make
here?
the same, yeah, we'll make the same asset allocation. And that
Perfect.
cost value you could update if you knew what the ACB was for the account. It just defaults to the same as the value of the account, but you can edit that.
Perfect. All right. So now, when we've input information for our client, either our client or the spouse, we're going to look at some of these action buttons also show up. Now, because Jay has similar asset accounts like Barbara, rather than inputting them from scratch, we're going to use another trick here where we can copy information to spouse. We also have option to move information between the client and spouse if we maybe entered it by error. So I'm going to use the copy button to do this information here. We're not going to see any of these buttons under the open joint account because it's the same between both of them. It's a joint asset. It's going to show up under both Jay and Barbara. So for the TFS and RSP, I'm going to hit the copy button. It's going to ask for a little confirmation there, and the same for TFSA. Now, once we've done that, if I'll jump under Jay's tab, we're going to see the open account obviously is there, RSP and TFSA, and the default that's just there by default. So I'm going to delete that. And the open account is great. Let's confirm the values for RSP from Lee.
So the RSP is $150,000
But this is different. Let's update that. And the
and the
TFSA.
TFSA is $85,000 as well.
Awesome.
And the other button that you didn't mention there under actions would just be if you wanted to move the assets around. So if you always want to use RSPs, then TFSAs, and then open, like if you want the same order as what Barbara had, you can just use those arrows to move it up and then save it. So now we have that same order.
Awesome. So when I did that, I reordered it similar to Barbara. Now let's look at the contribution rooms for them. So do we know what the unused contribution room for Jay and Barbara is? We can go under these tabs to update the information. So if I click on TFSA, we can see the unused room by default is 6,500, which is the most recent unused room for the TFSA. But if we know if it's any different, as per maybe our client's notice of assessment, we can update this right here. And the same for RSP and RIF here. Now for RSP, it automatically calculates 18% of the employment income that we have input for our clients. But if it's any different, which is probably the case for Jay and Barbara, we can update that value here.
So we're going to use $20,000 for both of them for the
Okay,
RSP contribution room.
so let's do that right here. And I'm gonna go under Barbara to ensure the information here. The TFSA is the same. And for RSP, like Lee said, it's 20,000. Okay, thanks for that, Lee.
And Jay also has a pension adjustment because he has that defined benefit pension plan. So we could give him $9,000 pension adjustment, which will basically just reduce the RSP contribution room in his plan every year by that amount indexed over time.
Awesome. Thanks for that, Lee. So I'm under J, under RSP/RIF tab, updated the pension adjustment. We also get the option to look at the conversion of when we want to convert the RSP to RIF. As default, it's going to stay at 71, but we could edit these values. And also the check mark to base minimum RIFs on the age of the younger client. So we have the option to check that off as well. Awesome. Now with that, let's head over
Go
to
to the
the real
house.
assets. Yes.
Okay, so they have a joint home that's $550,000 value.
All right, perfect. So again, like I clicked away after inputting this information, it already populated the cost. The value is going to be the fair market value and the cost is going to be the purchasing cost for the clients. We're sticking with 2.1% as the appreciation. We have the option to input future purchase or future sale age in case of use cases where we want to show an, maybe an upsizing, downsizing of the real assets. We can either input the age, very similar entry, or be more specific by inputting the date, month, and year of the sale or the purchase. Leah, you mentioned this is a joint asset.
Yeah, so it's a joint asset, and because it's a principal residence, there's no capital gain tax, so it doesn't really matter what we entered for the cost, because that
Mm-hmm.
value wouldn't be used. But if they do have a second property, then you can definitely put in what the original cost was and capital gain tax, yes, so that if they sell it in the future or if part of the estate, it will calculate appropriately.
Absolutely. Awesome. So I'm going to hit next and go on to the next input here, which is debts. So let's add a debt for them.
All right, so they do have a mortgage that has $72,000 balance, and they're paying $1,200 a month. The interest rate is 3.5%.
All right. So I've input the monthly for them. It's a 3.5% interest rate. We will see this option of future start age. Now, this is helpful when you want to input any mortgage or any debt that you know might start in future. This could be either for a mortgage or a vehicle purchase debt that they might do. So again, we can either start it by the year or be more specific by date, month, and the year as well. Sorry, we can start it by the age here. This is a jointly owned asset, so let's put yes here. We have the option to input if it's tax deductible or not. We are going to see this option of real asset where we can select if the specific debt is linked to any real asset in the list of assets we have. In this case, this mortgage is linked to home, so I'm going to select that. Now, the advantage of doing this is if we do sell off this home in future and there is some outstanding mortgage balance, Snap will make sure to pay off the remaining balance of this mortgage to close the accounts and then use the proceeds from the house sale for maybe investments or for client to purchase another property, whatever we want to show in Snap. So with that being done, I guess we're good to move on to the next step.
Okay, government benefits.
Perfect.
All right, so you can see that SNAP is automatically using a national average for CPP, and we have an update from the questionnaire to say that we're going to use 75% of the maximum for both of them.
All right, so 75% will change the value of J's CPP here. We're going to stick with 100% for OAS values. You will notice some options of prorating it. We're not going to do it for them in this case. We have the option to index the CPP year after year with a different percentage than in our inflation percentage. So if you want to change that, We can illustrate survivor pension, which is checked off. I'm gonna go under Barbara's tab to do the same 75%.
And we're also going to start it at 63. I'm sorry, at 65 for her. So it defaulted to 63 just because that was her retirement age, which again was the default because she'd be retiring at 63 if Jay is 65. So we
Mhm.
wanted to show an example where they aren't the same age, but you could have her work another couple years if you want to, but we're just going to follow with making it easy, retire in the same year.
Yeah, well, that's great. And you will notice that the value of both Jay and Barbara's pension amounts or CPP is different. That's because Jay is relatively younger than, sorry, Barbara is relatively younger than Jay. And so we are also looking at some enhanced value or the enhanced contributions that she might be doing more than Jay is. And also we are adjusting the values to inflation for those additional 2 years. Awesome. So now we do have other inputs that we can do as we see things like insurance, education, that's for RESP inputs. If your clients have kids and they want to input RESP accounts. There's also corporations where you can get in more details for self-employed clients. In our questionnaire and our information, we do not have all of this for Jay and Barbara. So I don't have to really go through all these pages to get onto our planning pages. So I'm going to use the menu right here and click on planning pages to get onto the information and look at some of the numbers.
Yeah, so
So
their main question, just to remember why we're doing this plan in the first place, was just, are they saving enough to meet their retirement goals? And if not, what could they save? Or what could they spend in retirement if 108,000 was too much?
absolutely. So thanks for that quick reminder, Lee. Now, when we get onto the planning pages, you notice we have 3 steps to creating a client plan. We have first a scenario setup, where we have input all the information successfully for Jay and Barbara. Then we are looking at the planning pages, which is this place where we get all of the client's information on this one screen. And then finally, we have client report where we are able to create this client digestible report that you could share with your clients in the form of PDFs, or even if you want to discuss it in the meetings. So now the planning pages have everything on one screen. We will see 3 tabs for planning pages in case of a client and spouse. There's the combine page that gives us cumulative totals of values between Jay and Barbara for their different accounts. We have Jay and Barbara's individual tabs to look at their individual specific numbers. So let's quickly go and look at this whole screen in detail. So we initially have this 3-level menu that we are looking at. First, we look at the top level menu, which tells us clients. If you click on it, it brings us back to the client list. It gives us details of our client that we are currently working on. And then it says scenario 1, which is our first scenario for these clients. We have the option to create multiple scenarios to discuss multiple what if options for Jay and Barbara. We also get this quick little advisor note, or also the scenario notes, where we can get in any information from Jay and Barbara Steele. And this is only for the advisor to see, and it will not appear anywhere else in the plan. So in case there's anything you want to ask them, or any quick reminders for yourself, you can input those here. And then we have these 3 lines where you can click add to rename the scenario, copy the scenario, or delete the scenario. So copy scenario is, of course, the most popular one. It gets you to create multiple copies of your base plan. And then you can edit information to maybe, look at some other what if situations or other plans for the clients. And then we have the second level menu that we just talked about. We have scenario setup, planning pages, client report. You could go back and forth between these to look at some of the information that you have added. And then finally, we have our third level menu. We're looking at the combined page and G and Barbara's individual plans. You can add a corporation from here. We have the option to export data. We're going to review the charts, which is another place. Recommendations, which is our place to look at some of our what if options. Again, we're going to touch base on this. And finally, the run scenario button. Sorry, the run scenario button that gets us to ensure that any information we add in the plan, we're able to run it and compute it in the plan to look at the latest information that we have and to look at the projections again. Awesome. So let's go on to this planning pages quickly and see from left to right what all information we have for the clients. So first we have, of course, their age. We're looking at the year and the corresponding age for Jay and Barbara. We can look at these two expanded sections. One is the cash flow management that gives us the start age of our different cash flows, the net cash flow and cash balance column, which in an ideal plan will be zero. And in some cases, which we'll look at in just a few minutes, there's going to be shortfalls or surplus. So these are the two columns you want to keep an eye for any shortfall and surplus in our plan. Then we look at the expenses section, which gives us the real base expense for our clients, and the nominal column, which is the inflation adjusted column. And then we have this additional expenses. If you remember, we added this vacation, which is going to show up as a separate column, and we can look at it getting adjusted to inflation every 3 years in the plan. Finally, we have the incomes for our client, the pension information. In this case, it was just Jay who has the pension. We have the government benefits, the tax. If I expand, it's going to give us more details related to tax information. We have the capital assets that gives us all the four categories or all different categories of clients' capital assets. I can expand these to look at more details on contributions, all the different type of capital assets that G and Barbara has. Then we're looking at the debt section. So what is the total owing? We can notice that the value is decreasing every few years or after every year because of the amount that's being paid towards it. The real asset, which gives us the increasing value of the real asset because of the indexation. And then finally, the balances section that gives us the net worth. What is our client's net worth together? What is their estate situation before tax? And finally, what is the tax on estate? Now, a quick thing or a quick reminder is anything that you see in blue and purple in Snap, they are all editable numbers or they are clickable. Either I can click on these information to edit anything different that I want, and that those are called overrides, or like under the estate before tax section where we can click on it and it will bring us to another table that we can look at with our clients or few extra data points to review. When we go under J or Barbara's individual tab, that gets us their individual numbers. Like you would notice our total additional taxes. If you remember, Lee mentioned that this is going to be split 50-50% between our client and spouse. So the
The
10,000,
expense, the
yeah,
total expense, not taxes. Yeah, just
my bad, the total
misspoke
expenses.
that. Yeah,
Yeah, that's going to be 5,000 between Jay and another 5,000 for Barbara to spend. And of course, we're looking at other values as well. So, Lee, do we want to input the TFSA contributions for them at this point?
sure. So now that we're on the individual page, you can see there's a lot more blue and purple values, which means that this is where you're going to be doing most of your editing is on the individual planning pages. The combined page is a lot more of the summary, which it has all the information from the individual pages so you can see it. But if you need to edit anything, you need to come to the individual page. So this is where we'll enter the TFSA contributions that are going to be 6,500 per year until they retire.
Awesome. So I'm going to use this contribution withdrawal column, and we're going to click at the first $0. And like Lee mentioned, it's 6,500. We have the option to copy down until 864. We can change it if you want to extend it, if you want to index it to any percent or the general inflation. Clear override is used when we want to clear any of these inputs that we have done and we don't want them in the plan. So I'm going to stick with copying this information to 864, hit on the check mark. We're going to notice these two values. If you remember, the run scenario is for us to compute any new information we added in the plan. And then when it turns red, it's our cue to click on it to update the information. All right, so now we're going to notice that for our J, we have 6,500 input here, which is our pre-authorized contribution or PAX into the plan for annual values. And these show up as yellow highlights, which are called overrides in SNAP. And we're going to go under Barbara to do the same thing for her. They have the plan to put contributions until they retire. So 6,500 check mark. Now for her, because she's retiring at 863, it's giving me the value until 862. So I'm going to go with that and click on run scenario.
And you're scrolling around pretty fast. Just how do you go so quickly left and right?
So, like I said, either we can use this like little scroll bar at the bottom to go on to all the information. Now, obviously, when we're looking at individual numbers, they're going to be more. So we're going to have a longer or a horizontally large screen. Or if you are using your mouse and you have this roll wheel that you're using, you could press Shift, and that will let you do the horizontal scrolling on left to right in the plan, and that will make it easier for you to look at all the columns.
Yeah, so shift up on your scroll wheel is right or left? Script, I forget. Shift scroll down is left and shift scroll up is right. Or if
Right.
you had a trackpad, I mean, that would let you go left, right as well.
Yeah. Or like I said, like you can use the this
Yeah,
little
or
scroll
you
bar here.
grab the bar. Yeah, exactly.
Okay, now so with that information input there, we have everything that we needed from the client's questionnaire to get to the point of answering the main pressing question for Jay and Barbara. Are they doing okay with the amount of spending that they have in mind? So when we are onto the combined sheet, the first thing we're going to notice here is our base expense of 108,000 input there. If it's any different, we can click on it at any year to change this value. For now, we're going to run with this 108,000 of spending at the retirement age until the end of the plan. And if we scroll to the very bottom of the projection, we will notice that there are some values in our net cash flow and cash balance column, which tells us, and because they are negative and in pink highlights, it tells us that the client is running into a shortfall situation. Now, the net cash flow tells us the each year's shortfall amount if they continue to live that lifestyle. And our cash balance column tells us what is going to be the cumulative total or the cumulated shortfall if our clients were to borrow money to continue with the lifestyle. Then what will be the final amount of their shortfall? In this case, it's about 417,000 of a shortfall amounts. Now, at this point, if you want to answer the client's question, are they doing okay with the amount of spending that they have in mind post-retirement? The answer is no, because they want to spend 108,000 each year. So this comes to our next point where we are looking at maybe we can consider getting them to spend less when they hit a certain age in their retirement, or as they grow to more towards their old age, maybe they want to spend less money. So I maybe in this case, let's say at age 80, if we click on that 108,000, we can get the clients to spend 95,000, which is slightly less than what they're spending right now. And I selected age 84J, which is year 2040. I clicked onto the real base expense. I'm inputting 95,000, copied until age 100, click on it, and the run scenario button is turned red. So I'm going to click on that to compute the numbers. And let's scroll down again onto our base expense to see how things are looking. We are till age 100. There isn't any shortfalls in the plan, and it seems to be doing okay. Another place to look at these numbers is under our balances section, especially under the estate before tax column. I'm going to click on the last year estate amount, and that will tell us what the client situation is. We're not seeing any debts, so things are looking good. They have about 406,000 left under their combined estate. We can look at individual G and Barbara's um, sections as well to look at how much money is left in their individual accounts. We have the real asset, which is always going to be intact. So quick reminder, at no point in the projection, SNAP will decumulate money from the client's real asset because this is a not liquid asset section. It gives us the total asset and then what the final net worth is. We're looking at the estate before tax, which is $1.6 million. There's a little bit of tax on estate, which is based on where the capital asset money is sitting. It could be an RSP account, which is taxable, or non-registered, which might have some tax component to it. We're looking at the estate before tax, and finally, what is the estate after tax in real dollars, which is in today's dollars. And the estate before tax, sorry, the estate after tax in nominal dollars is the amount that they have in estate in 2060 in nominal terms. Okay, so now that gives us a situation that they can do okay if they do decide to drop their spending to a certain different value. But here we can also look at the recommendations button for our client to answer some of these questions for them on their retirement. Sorry, I want to go back and change this spending to 108,000, and let's copy it down to age 100 and come back to that little shortfall again.
And what does that shortfall look like in the chart, Anu? Can you just show us?
Okay, that's a great point. So let's go back here. We can see the shortfall again. We have that 417,000 of shortfall. If I go under charts, we will be able to look at the cash outflows, which gives us different sources of money, the outflows where our money is going. There's base expenses, there's vacation, by the way, which we said highlighted yes in our input, and it's highlighting right here as a vacation section. We can see some of the money going under income tax. There's some debt payments our client is doing, and some money that's getting contributed to capital assets, which is our TFSA contribution. Now here we have the total inflow of money. So we're going to notice that from age 94 and after, if you notice, there are these shortfalls because the inflow is lesser than what our outflows are. And that's how we get to know that there is shortfall in the plan from the charts. So you'll notice that the different sources of base expenses and maybe even income tax is obviously more than the total inflow line that we have here.
Great, and thanks for showing us how you can just hover your mouse over the legend there and highlight things in the chart below.
Yeah.
Or you can actually click on items to remove them from the chart altogether and then add them back in. So it's an interactive chart that you can use. And you can make it full screen if you wanted to as well with the menu there.
Yeah, we can full screen it, or if you want to download in a specific type, we can do that as well. And likely mention, we can hover over these, or even if you want to get rid of certain sections, maybe income tax is not something they want to focus on. So we can look at all the other expenses or all the other cash outflow sources. So we can look into that. Awesome. So coming back to the shortfall, there's of course this shortfall right here. If we click on recommendations, it gives us different calculators to work with. We can get our client to work longer. We can get them a big lump sum of money now that they can invest to not be in a shortfall. They can also look at considering saving more than what they are doing right now. Or one of our most popular calculator, which is looking at sustainable spending, which gives the clients the maximum sustainable level of spending at their retirement age so that they can know if 108,000 or 9,000 monthly is not a doable number, then what can they possibly spend to not be in a shortfall with the amount of money that they have in their assets right now. So we can hit calculate, or if you want them to start this calculation from a different year, we can click onto their age, which is in blue, and like we had that blue, anything can be edited or clicked. We can click on it, we can change the start age of the sustainable calculator, and we can reassess the number. So I'm going to stick with the retirement age for G and Barbara and click calculate. It takes a few minutes to crunch some of those numbers and it will give us the amount. Awesome. So it now tells us not 108,000, but about 3,300 less, which is 104,686 would work for the clients to be 100% funded. Right now, they're obviously underfunded. That's what their goal status is. Now I can either hit apply and run to put this number in our base expense column directly, or we can copy this scenario before applying recommendations. That gives us a second what if to look at. So I'm gonna check mark that and I'm gonna say apply and run. Okay. And we will notice at the very top of our menu, it now says scenario one bracket sustainable spending. So now we have two scenarios, one with a sustainable number. And we are going to notice that we have this 104,000 right here in our real expense with no shortfalls in the plan. Our clients, if we want to go to the state summary because it tells us a few more information there, the assets are almost exhausted. We have attained the maximum level of spending that the client can do. The real asset, as we discussed, is never going to get liquidated unless we actually sell it in the projection. And we can see now the client's final estate in nominal dollars is about 1.2 million. When we have multiple plans, we will notice that there is this little button that says compare with other scenario. Now, this is a great thing if you're creating multiple plans for your clients and you want to look at them side by side, especially their estate and net worth summary. If we click on it, we will get to see the value or the information of net worth and estate from the other plan. Here, our clients had big debt, which left them with little money in their estate after tax, versus with the client now spending up to their maximum spending levels, and they have more value left in their estate. So these are some really great things to compare with our clients in their when you're running with their projections. So I want to close this, and I'm going to use these three lines to switch back to our scenario one. And there's one last thing that we want to focus on. If you would notice that the base expense starts from the client's retirement age. But what is happening before their retirement years? These numbers are different. And if you would notice, we cannot edit these numbers. So SNAP really runs on two different cash flows in the plan. One is our manual cash flow, which is happening before the client retirement years. And there's another one that's happening after the client retirement. That's what we call as the automatic cash flow. Now, in case of manual cash flow, what SNAP really does is we do not ask for what the client wants to spend in base expense. The focus is that if they want to do any savings, we are entering the savings manually. And how the base expense is calculated is the client total employment income, which is the employment income that Jay and Barbara has, minus any set expenses like their total tax, any contributions that they are doing manually. In this case, we did their TFSA contributions into their capital assets, and any other set expenses that we have here, like the debt payout or in case there's an insurance premium. Now, once all of these values are taken away from the projection, we assume that the remaining amount from the employment income is spent by the client. And that's why here you'll notice that we have 110,000 of the real expense left after the vacation expense was taken out. And in the next year, there's about 120,000 that the client is spending in real dollars because there isn't any vacation, and it is slightly adjusted to the inflation. So the value might be slightly different for all the years here because we're also focusing on the inflation adjustment into the plan. And after that, when we have the retirement age, we're looking at a consistent spending because that's the input we are doing for the client. It's a constant that we have selected. And based on this amount and adjusted to inflation, what we see in the nominal dollar, SNAP will start to decumulate our capital assets on what is the client's requirement of their spending. And that's what we call as an automatic cash flow because now the software is taking a little bit of control of decumulation, and it will be able to withdraw money based on this cash flow management strategy. And it will tell us when the client has a shortfall or how much their money will last to a certain age. Just to answer one last question that might come up, and if you are curious about that, how the decumulation is happening is based on a sequence. If we look at the capital assets right here, we can click on this gear icon and click on show the cash flow management order for this scenario. Now, this is something that you might have to click for this scenario. If you want to keep it on for all the scenarios, you can click on show the cash flow management order for new scenarios. I'm not going to do that. I'm just going to stick with the first check mark, hit save. And we will notice if we are under J or Barbara's tab, because the withdrawals are happening under their individual tabs, we will notice this cash flow management order starts from the retirement, which tells us if there is a surplus money or there's extra money, SNAP will follow the sequence of RTN, which is RSP first, TFS is the next, non-registered the third. And if there is a withdrawal that needs to be taken out or decumulation that is happening, SNAP will withdraw money from non-registered first, then the TFSA, and then the RSP. And these are just defaults. We can always click on it and change the sequence if our client has a different goal in mind, or if there's a different way you can make the plan more optimum for the client.
Two things just came to mind anew.
Yeah.
One is just to highlight that CFM start age button. So that's what actually controls where the manual cash flow management switches over to automatic.
Yep. So
And you can use
there
the
we
radio
go.
button, or like you said, you can click this gear icon and you could turn it off for the entire scenario or select the age using
Absolutely.
this.
Yeah. It's just the defaults where we have the cash flow to start from retirement. We can change it. Like in this case, if you want, we can get the 108,000 to start from our year 2023, and that will have a consistency of the clients lifestyle spend.
And the other thing is under the combined page here, if you expand out the capital assets header there, use the expand button. So you can see all the details for the individuals as well. You won't be able to edit it, but if you hover your mouse over the name, like the title, so you can see Jay's name pops up for that RSP and joint for the non-registered, and then there's Barbara's. So there's all the information. You didn't have to switch back to the individual page to see it, but to edit it, you would have to switch back.
Thanks for that, Lee. And of course, when it comes to editing, if there's anything that you want to edit, we don't always have to go to the scenario setup. You could just click on the section and it will bring you back to the inputs or the edit page. And that just makes it easier for you to do any changes while you're in the plan. Okay, so with that done, we've solved for the client's question if they're going to be okay with the spending. No, it's not going to work for 108,000. Like we said, we can either get them to spend less amount in the future, or I'm going to use these 3 lines to switch into our sustainable spending. So we could let them know, well, not 108,000, but $104,600 would be a more sustainable spending plan for you. Type in toolkit here. There's going to be a really neat article that comes up that gives you the financial planning questionnaires. These are blank questionnaires that you could either share with your clients, or while you're in the client meeting, you could get, all the information to input in Snap. So all the questions are asked right here, which is both a long financial plan, which includes corporations, and the shorter version. And then finally, we have this new financial plan creation checklist, which is great when you're ready with all the information. You want to make sure that you have got everything that's required, and a sample report that you could look at for short version and long version to see what would a good short sample plan or a long sample plan might look like. So you could use all of this information right here. These are super helpful when you're getting into the client meetings. There are also some really good webinars and blogs that you could come back to and look at